Hello, everybody. So today I want to cover 3 earnings reports that came out today. So the first one was Rivian, and some of my viewers have asked what I think about Rivian and if I could cover Rivian really quickly. Well, today the earnings weren't really good at minus 25%, and the reason why this stock dropped quite a bit at minus 25%, you see the market is still unforgiving. We have quite a bit of stock we have seen drops like this. Well, it is because, as the CEO said, the demand is weak. The demand bank, as he called it, is kind of low, running kind of low, and so there is not a lot of backlog, and the demand is weak. And of course, he blamed interest rates. And there's a new model of Rivian that should come out that could potentially compete with the current Model Y, but the problem is that by the time that model comes out, the Model Y might be even cheaper, or there might even be a Model 2. So, the strongest company in the EV space is and remain Tesla. The question is, can Rivian make it? If Rivian makes it, maybe Rivian can be a small percentage of what a Tesla could be in the future. But, these markets tend to be winner take all or winner take most markets. As Elon Musk has stated, famously, he only knows of one company that hasn't gone bankrupt in the car space, and it's Ford. And he kind of put Tesla in there, but Tesla, of course, was a very young company. Now, I don't think Tesla's going to go bankrupt. I think he meant to say Tesla and Ford are kind of the only 2 companies that made it over the long run. The point being, it's a very, 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 very tough business. And so imagine if Rivian is having such issues with the demand. Imagine how Lucid must feel. I mean, Lucid is even lower quality than Rivian, not as far as the product goes, but as far as the scaling and as far as the demand goes. The CFO in there guided for a loss, an EBITDA loss in 2024 of $2.7 billion. So that means that as they ramp, they lose more. The more they sell, the more they lose. They need to reach a minimum capacity so that they can get to a positive gross margin. But as long as they don't get to a positive gross margin, as long as they don't cover the insane fixed costs that go into manufacturing a car, they can't have positive gross margins. So they are nowhere near covering the fixed costs necessary to run those plants. That's why the gross margin right now is minus 64%. Now, if they ramp, if they actually increase their sales by 82%, like analysts are predicting, next year we may have a minus 30% gross margin in 2024, and maybe in 2025 we'll have a minus 5% gross margin, and maybe in 2026 we'll finally be positive. But they better ramp fast. They have to ramp fast. And the problem is that analysts are predicting 82% growth over the next 12 months. Well, that's likely going to be lowered after the comments of the CEO saying the demand is weak. Yeah, these trucks, they're beautiful trucks, but they're expensive. And keep in mind, there is the Tesla Cybertruck. Well, if you can get your hands on one, people will choose a Cybertruck, I believe, for now, if they can get their hands on one. But then you also have a similar looking truck in the F-150, and Ford is running a lot of sales, a lot of promotions on the F-150. So there is competition here. Now, how about a few good things about the stock? Well, as you know, this stock has a 15% investment by Amazon. So the question is, would Amazon put a little money in there? Could there be more backing from Amazon? That's one of the catalysts. And the other catalyst is that when you look at the balance sheet in terms of net cash, right? So cash minus debt, they have about $6 billion worth of net cash. So that means at this loss rate of predicting $2.7 billion of loss over the next 12 months, that means they have a little more than 2 years worth of losses that they can afford. They can afford to lose money for another 2 years before they eventually run out of money. And of course, if the stock market sees that they will run out of money, the stock price, can be, another minus 90%. This can be $1 stock. If the market sees bankruptcy, for now, this stock is valuable. This stock is expensive because the market still thinks Rivian can make it. But it is a binary bet, in my view. That's truly a binary bet. And the concern, of course, is the low demand, right? Rivian is one of these companies that really needed a drop drop in interest rates last year. Like it really needed it last year. And if not last year, it needed it in March. And it's not going to get it in March. Every time Jay Powell delays the drop in interest rates, this company is going to see lower demand. Low demand is a major concern. In my view, for me to invest in a company like this, I would want to see something like 200% type growth to invest in a company like this. Now, they are a very, very rare company. That would be a company like a Transmedics in the early days, or I suppose it could be a company growing as fast as NVIDIA. NVIDIA is a stock I'm not going to comment on because everybody else comments on it right now. But, what a regret I have of having sold NVIDIA. But I would love to see that type of revenue growth for Rivian, but it's not. And do they need it when they lose so much money? So the more you sell electric vehicles, the more you lose money until you break even, but they are nowhere near that break even. And Rivian is a gamble. That's a long-term gamble. We'll see how they do. It's an interesting talk. Thanks to my viewers for suggesting I cover it, but I'm obviously not buying, and I wouldn't be interested in this company. And I'm biased towards Tesla, of course. Tesla is my number one position. Lantheus. Let's talk about Lantheus. You may remember me adding Lantheus a month and a half ago. Well, I'm very happy I did because the stock is up 15% today, and it's been consistently up. Recently, Lantheus is a stock that when it first came up in my screener, it was as cheap as HIMS, which was enough for me to buy. Now the stock has run up quite a bit. Quickly, what does Lantheus do? They are a radiopharmaceutical company who happens to have a quote-unquote blockbuster drug in the radiopharmaceutical space, which is called Pylarify, which is a drug that helps patients avoid false negatives when they get cancer scans. And it's a drug that's been getting more and more prescribed before you go through a scanner to see whether you have cancer or not, because the drug makes the cancer visible by the machine. A very interesting company. I have my positive bias towards this company because I was lucky to invest in AbbVie and their Humira drug many years back, and I remember it was an outstanding return, and I saw similar patterns on this one, and the stock was very cheap. Again, love everything about it. The only thing I don't understand in this stock is why is their guidance so sandbagged? I mean, they might as well have not given us any 2024 guidance. They gave us a nice guidance at almost 1.5 billion in sales throughout 2024, but that seems extremely sandbagged. And in fact, if I input that number, that would be 11% growth, and that would make the stock, granted, still cheaper than the average stock in my spreadsheet. I'll give them that. Even with that sandbagged guidance, still a cheap stock, but nowhere nearly as cheap as if I were to use the analyst's number, which are still at 49% predicted revenue growth over the next 12 months by analysts. And I myself, when I analyzed this video, I was predicting something close to a 4x in sales in 4 years as they go into Europe and perhaps even Asia at some point. And so, the delta is huge. The question is this company going to actually achieve 49% or is it going to be 11%? Someone in the comment section a few days back was kind enough to tell me that they think the growth is going to be closer to 20%. This is the big question mark. How big is the growth going to be? We know it's going to be higher than the rate of the economy. And for some investors, that may be enough to invest. And if you are a PE investor, right, a price to earnings ratio investor, which I'm not, I'm a hyper-growth investor. I look at gross profits. But if you're a PE investor, the forward PE of this company is a 9.7, which in and of itself is compelling for a company that is nowhere near dying and that is at the forefront of its field with a blockbuster drug. So that would be a very cheap stock, but I don't use PE. I use my metrics. So I'm still thinking the analysts are more right than wrong on this one. And I'm still thinking the guidance is sandbagged because managers, they really have no upside to give a high up guidance. They want an easy time for themselves, and you give out a low guidance, and that way whatever you achieve, you meet that guidance and you get your bonus and all that sort of stuff. So that's why I think the guidance is so sandbagged. I wouldn't be surprised to see the growth go significantly higher. Again, briefly talking about NVIDIA, right? NVIDIA keeps seeing demand significantly higher than what they guide. Perhaps only they know what the actual demand for a product is going to be, and perhaps it's even higher. That's why NVIDIA keeps raising guidance every single time they report. Last stock that I want to cover today that dropped their earnings is MercadoLibre. Now, MercadoLibre is one of these. It's down after hours right now, 9%. Frankly, these are those stock drops, those drops in prices that I absolutely love. MercadoLibre is down 9% after hours because of a one-off tax expense, and that's something they have a big tax expense that they expected since 2014, and they've had separate accounting for it. So they've already accounted for that expense, but they have to recognize it in the form of EPS. And so the algos are seeing, the EPS came out, minus 50% compared to what it should have been, and boom, the algos sell the stock. But in the case of MercadoLibre, they had fully provisioned that tax expense, and it's not going to impact the company. But the market being the market, reacts the way it does, and the market is still heavily influenced by GAAP earnings, or IFRS in the case of MercadoLibre, IFRS earnings, and it's nonsensical in my view. The market should look at the long run. Over the long run, this stock, if you remove the one-off tax expense, this stock over the long run would have beat its earnings target, and it, of course, as always, it's kind of a boring stock to own because they always beat. They've beat their revenue, and revenue is what I care about the most. The revenue was $4.26 billion in Q4. They were expecting $4.13 billion. Analysts were expecting that, so they beat their revenue handsomely, which is what I care about. In fact, if you look at the trailing 12 months growth, e-commerce, which is their main business, grew 42% year over year, trailing 12 months. And their fintech division, which is payments on their platform, but also micro payments for micro businesses, their fintech division grew 57% year over year. So this is still a stock that's predicted to grow tremendously. When I use analyst numbers, I see analysts are only predicting 35% revenue growth for the next 12 months. I obviously think it will be higher. I didn't see any guidance from MercadoLibre. MercadoLibre doesn't really give any guidance. The stock is cheap. It's in my top 30% cheapest stock in my spreadsheet. I consider anything under 0.5 a good price. We are significantly under 0.5. Granted, it's not HIMS cheap, it's not Stone Cold cheap or Lantheus cheap, but it is still a cheap stock. And as far as cheap stocks goes, quote unquote, you're still paying a premium for that stock because it's a cheap stock, sure, but it's a steady Eddie sleep with a swan. That's what I mean, swan. Sleep well at night type of stock. I mean, this stock, it doesn't require, in my view, for me, it requires me very little following, if any, because it's just so steady Eddie. Yeah, it's very clear. They're the Amazon of Latin America. They're the leader. They're beating Amazon just about everywhere they go. They snatched up stadium naming rights for some soccer stadium in Brazil that Amazon really wanted. They were able to get that, and if you do the rule, right, the rule of 40, they handsomely exceed the rule of 40, because if you had 35% next 12 months sales growth, and you 35% plus 90% right now EBITDA margin, you get a rule of 54, which is well above the rule of 40, which is considered an attractive business, at least in the digital space. So nothing for me not to love about this company. Very happy to own it. I would not add to this stock because it rode back up quite a bit, especially before those earnings. The stock rode back up, so I think the stock is not suffering from any pricing anomalies. Perhaps it's a little cheap, like I said, but not that big of a pricing anomaly for this stock. This is a stock that I want to own for a long run and just benefit from them capturing retail sales and e-commerce sales in Latin America with a little bit of a fintech division. To show you kind of how steady Eddie this stock was, of course, we kind of had the scare of 2020. That's pretty normal. But if you avoid that scare of 2020, where this stock had a little bit more variability, a greater beta than your average triple Q as a whole, your triple Q index. But if you look at it, if you go back to 2007, which is as far back as it goes for MercadoLibre, you had 15% for the Nasdaq, 28% for MercadoLibre. So not quite a doubling, but almost a doubling what the Nasdaq does. And this is a stock that historically has returned the type of return that I look for. I look for 30% a year return on my stocks. I realize it's a very, very lofty goal, but that's what I do. And this one has achieved 28%. So I'm very happy about that. And I think it's a stock that's well poised to continue growing over the long run and will benefit from the development of Latin America as a whole. Happy to own Mercado Libre. So, this was not financial advice, no investment advice. This is just entertainment. I appreciate your likes. I appreciate your subscribe. Thank you so much for watching and have a wonderful day.